For the last 5 years, the American housing market felt completely locked into an endless upward spiral. Home prices surged, bidding wars became the norm, and buying a house seemed permanently out of reach for the average person. But the latest data shows a sudden reversal. This chart tracks 129 major U.S. housing markets. Nearly 1 out of every 3, 39 of them, saw prices fall. Nationally, the era of double-digit returns is over. Growth dropped from a 19% peak in 2021 to a mere 1.3% today. Some of the most extreme reversals are happening in the exact cities that defined the pandemic housing boom. Markets like Austin, Texas, and Denver, Colorado are leading this downward trend. For buyers who have been sitting on the sidelines, these falling numbers look like the exact opportunity they've been waiting for. The headlines point to lower listing prices and assume the market is finally healing. But buying a house based solely on a falling sticker price is a massive risk right now. A declining median price can mean one of two things: a healthy economic correction or a market that has become financially toxic. To see what a toxic market looks like, we have to look at the Gulf Coast of Florida. This region is currently offering some of the steepest housing discounts in the entire country. Looking at the top falling cities right now, Cape Coral is leading the major metros with a 10.2% decline in median home values. Just up the coast, Northport has experienced an even steeper drop, down roughly 20% from its peak. Sellers are cutting prices, but it isn't because of a normal economic slowdown. The aftermath of severe storms like Hurricane Ian has left a massive overhang of damaged properties flooding the active inventory. This data card breaks down the real issue. Florida's average homeowner's insurance premium is now over $8,000 a year. In coastal zones, it exceeds $20,000. Homes sit on the market for over 80 days because buyers cannot afford to insure them. There's also a secondary issue hitting the state's condo market. New structural inspection and reserve laws taking effect in 2026 mean that older buildings are forcing massive, unexpected HOA assessments onto their residents to cover deferred maintenance. The initial listing price in these areas might look like a steal, but the discount is an illusion. Once you factor in skyrocketing insurance premiums and mandatory HOA assessments, the true cost of ownership is completely unsustainable. We can prove this is a regional issue by seeing how the rest of the country handles the exact same 6.47% mortgage rates. When we look at historically slower, low-growth areas like the Rust Belt, we see a completely different housing market. This split-screen comparison shows the current dynamic perfectly. While Florida's statewide home values dropped 5.5%, Northeast and Midwest markets are surging. Detroit is up 17% year over year, and states like New Jersey and Illinois are growing over 5%. The reason for this growth comes down to basic supply and demand. These areas largely missed the massive speculation wave of 2021. Because housing supply remained tight and prices didn't artificially inflate, these markets are simply catching up to their actual value. We are watching a complete geographic reversal. The Sunbelt destinations that absorbed huge amounts of domestic migration and out-of-state capital over the last few years are now bleeding that same momentum. Because available housing is still highly restricted in the Midwest and Northeast, prices there continue to rise. That means the declines we are seeing down south are localized corrections, not the beginning of a national housing crash. That brings us to Interior Tech Hub, where we are seeing a totally different type of price drop. Unlike the coastal areas, these markets aren't dealing with an insurance crisis. They are experiencing a purely mathematical correction. This line graph traces the trajectory of Austin, Texas. At the market peak in May 2022, the median home cost $550,000. Today, that number has fallen just under $415,000. That drop of nearly 25% wipes out $135,000 in inflated value. Further north, Denver has also hit a wall. Based on the latest Case-Shiller Index, Denver holds the top spot for fastest falling home values of any major metropolitan area in the United States. Buyers in Colorado finally have real negotiating power. Right now, 16% of active listings in Denver have required 3 or more price cuts from sellers just to attract an offer. Between 2019 and 2022, prices in these cities doubled. What we are seeing now is that extreme pandemic-era bloat being shed from the market. This is exactly what a healthy market correction looks like. Prices are falling back toward local median incomes, while the regional job markets and tech sectors remain robust. For a prepared buyer, these areas represent genuine opportunity. The idea of a single, unified U.S. housing market is effectively dead. Instead, buyers have to navigate a hyper-regional chessboard, where a state's economic baseline matters far more than national mortgage rates. The rule for navigating 2026 is simple: never look at a listing price in isolation. You have to calculate the total cost of ownership up front, securing localized insurance quotes and factoring in rising property taxes before you ever make an offer. That means actively avoiding the highest risk inventory: pre-2000 Florida condos facing structural audits and homes situated in vulnerable coastal flood zones are financial liabilities disguised as bargains. As this chart illustrates, the window for the best deals is already starting to close. While Austin's median price is still dropping, pending sales volume has suddenly spiked by more than 15% as buyers rush back in to grab the discounted inventory. The 2026 housing market is a strategic reset. If you avoid the uninsurable traps and focus your attention on the cities undergoing healthy economic corrections, patient buyers finally have the leverage they need to actually secure a home.